Welcome to the Cash Flow Academy podcast. I'm your host, Andy Tanner. This is where we make investing simple, and I'm joined by two of my great friends, not just teammates, but great friends. Noah Davidson is here with us.
Excited to be here, Andy.
Noah Davidson. We have Corey Halliday in the house.
Excited to be here as well.
The team is here. We're going to speak a little bit about the events of the market. It was funny because our podcast has turned a little bit bearish. We're all believers in stocks and owning assets, but we've been given some warnings, and we had a big move in the market. When was it?
Last Monday.
Monday. And everyone thought, okay, this is the beginning of the end, but it really isn't what we were looking for. You were well prepared, but we'll talk about how we've been kind of preparing for this, and I think the big one's still yet to come. I think this was a blip. I think what happened was some big institution got in a squeeze, and they had to, there was a, not contagion, but domino effect. Someone got in a squeeze somewhere and had to do some heavy liquidation, caused other people to have to do some liquidation. I don't think it was a systemic issue. I think it was a portion of that. So we'll talk about why we think we had that really rough day. I mean, down 3, 4, 5%, whatever it was.
Yeah, at the worst of it, I think it was down 4%. But those type of market downturns, I mean, if you look at it on a long-term chart, it's a pretty minor blip.
Yeah.
There were some things that suggested it was worse, like the VIX kind of spot price shows a number that makes it appear as though it was a massive market move and a a la 2020 or similar to 2008, right. And it just wasn't that. And if you look at the VIX futures, they never got up to those high numbers. So it wasn't kind of a catastrophe or anything that was too significant, really.
So we'll get into that. First, go to yourinvestingclass.com. If you have not been there, and I was doing a stock cast for Rich Dad earlier, and every once in a while it occurs to me that I know there's a lot of listeners that come here because they're interested in financial education. I'm going to start to issue challenges to people to go deeper into that part of your life. We've got some bearish concerns that we'll address today, but I will just tell people if you've ever felt you could go up a notch in your financial education, do that now. Now's an important time to do it, so go to yourinvestingclass.com and check out what we have there. Quick introductions. Noah, maybe introduce yourself briefly for those that are new to the podcast.
All right. Hi, I'm Noah Davidson. I've been doing this for quite some time now.
Sporting some... You're sporting the Cash Flow Academy swag here.
I could plan my wardrobe where I could just throw on my Cash Flow Academy shirt and represent. But I like it, So I didn't know we were really going to be recording today, so I didn't dress for the occasion.
We did not plan.
No, that's perfect.
I think we did not plan. We have a meeting on Tuesdays anyway where we talk about where the direction of the education's going, and considering what happened last week, we thought, let's do a podcast. So,
by all means.
But you're still looking good.
Well, excited to be here. But so that's me. I've been doing this a long time. I've taught tens of thousands of people how to trade and invest, and I enjoy this stuff. It's like an addiction, maybe. I'm not sure. The first step is to recognize you have a problem.
Yeah.
This is my favorite meeting of the week. This right here is my favorite meeting of the week. Corey, quick introduction, please.
Yeah, like these guys, I've been doing this for a long time, a couple of decades now, and just love the markets, enjoy everything that is involved in the markets. Formerly worked on Wall Street as a Series 4 option principal, and now I love educating and teaching and sharing information, and I love what you say, students of the market, and we study together.
For sure. So let's get to our topic. One of the things that was interesting about this was the fear gauge. And maybe Noah, just if someone's new, explain a little bit about that VIX, the Volatility Index. They call it the VIX for short. And why do they call this the fear gauge?
Yeah. Well, the Volatility Index, the VIX, measures the implication of volatility on options for the S&P index. And when the implication of risk increases, the volatility index increases. And the reason that the implications of risk might increase are uncertainty And they'll call it the fear gauge because when people are a little nervous, they'll be willing to pay more for an option premium that can protect them. And so it's a measure of how much the insurance costs, really.
I like that insurance analogy because, if you look at how, let's look at the drivers in my household, okay? If the insurance really knew how little I drive, they lower my premiums. But, we have a 16-year-old and 18-year-old that have access to a red sports car that it's fast. It's my wife's car. It's her sports car. She's the one. She probably drives it the safest. I think my 18-year-old son drives it pretty safe. My 16-year-old son, I'm a little nervous about.
Well, when I was 16, I thought cars were for jumping. I grew up watching the Dukes of Hazzard, and so I'm like, you just go try to catch air off of things.
Yeehaw.
And let's just say I had got canceled off of a couple of different insurance policies before I wised up.
That's volatile driving.
Yeah.
So really it's about insurance about transfer risk. And when people are nervous, they want to transfer those risks to other people. And the higher those risks are, the more they cost. And so when one of the great ways to find out if something has more risk in it is to find out how much it is to insure that very thing. So if you have an 18-year-old who's got 4 DUIs already and is breaking the law in every way possible, that's a high risk deal, and to put that risk on someone else is going to cost you a lot. So anything you want to say about the VIX, Corey, in terms of how that insurance works?
Yeah, so the VIX is the measurement of the broad markets, but like you were saying, you can take it to an individual level. You can say, well, how much does it cost to insure this stock or that stock? And the same way, you've got teenagers in the stock market, right? If I want to go and insure Tesla, it's going to cost me more because that's a more volatile stock, right? Versus if I'm going to go in and insure Apple, which is a little bit more of an adult, it's not going to cost as much. And so there's a little bit more stability in some companies and a little bit more wildness in others. The S&P 500 is just, it's like sticking them all in a blender and mixing it up, and here's the average. And that's what the VIX shows, is how much would it cost to insure the broad markets. And so systemic risk, you kind of mentioned this. Systemic risk is when the market's melting down, and the VIX does a good job of showing that. And so seeing where the VIX is at, if it's around 20, you've got some volatility. If it's around 10, 12, 13, you've got very little volatility. Now that can get to a place where maybe the markets are too complacent, but that number tells you there's just not a lot happening right now. There's not a lot of catalyst. Now, when the VIX gets up to 50, 60, or if we go to 80 or 90, there's only a couple of times in history that we've seen numbers up there. That was 2008 and 2020. What's weird about this recent bout of volatility last Monday was the VIX went up to 65 is what it suggests. Well, that would put it in the same category as COVID. And 2008 when Lehman and Bear Stearns failed. And it just wasn't that. Yeah. So the VIX was kind of off. That spot price was just off.
Let's back up a little bit and talk about that VIX around that 20 level. And if you're new to investing, well, there's an opportunity for some learning to get familiar with where the VIX, where does insurance usually run, right? If you have car insurance, you probably know what a good deal is and what a not a good deal is. So as an investor, you'd want to have an idea of the general risk and how do people fear the market generally. And it was interesting because of the change in how the three of us have interacted in our little, 3-man text that we have. We have really big concerns, and we by the time this airs, the class will be over. But we had an exclusive event that we invited people to. It'll actually start tonight as of this recording, so it'll be over by the time this airs. But we went out to our student body at the Cashflow Academy, and we said, we're going to do a special class. We had a cool name for it. We called it the Armor Class. And Armor's like SWAT, Special Weapons and Tactics. Armor is advanced risk management and opportunity readiness. And we we kind of said, how can we articulate the anatomy of a crash, the anatomy of a pullback, the anatomy of a black swan type event? And, kind of like DEFCON, the military has nuclear readiness of nuclear threat. They call it DEFCON 0 or 1 or 5 or however it goes, and they move up. So when you look at when do we first get our spidey sense tingling? And that's actually when the VIX is very, very low, because there's not enough fear in this market. There's an overconfidence. And Warren Buffett said this, when it's time to be, when everyone else is really fearless and greedy, that's your first signal for concern. And that's really where Corey, between the three of us, started to lead this discussion. And he mentioned it. He said, boy, there's not a lot of fear out there right now. And the VIX was down in the teens, low teens, like 12 and 13. Yeah. There's no fear in this market. And when everybody is fearless, a lot of money's in there. Where's the money going to come to push it higher once all of this money's in? There's 401k money that constantly goes in, regardless of for no reason. Yeah. People get their check and put it in, but still something needs to feed that beast. And so what I thought was interesting is we set out our ARMOR curriculum for this special opportunity readiness and risk management class, is we said, in this sense, you'd begin with not like a full insurance policy like the world's burning down, but you tip your toe in some bear stuff. And one of the tough things to trade is the VIX, because the VIX spikes and it never stays there. Just fear is like fleeting. It's a lot like in the wild, the
fight
cheetah.
Or flight.
The cheetah chases you for a while, and then you get away, and you're like, and it's your blood pressure's right back down. So fear is not something that's sustained at high levels, so it can be hard to trade it. But I thought one of the brilliant trades you put on is we certainly wouldn't hedge all of our portfolios this way, but you made a trade when the VIX was probably, I'd say 12, 13.
Yeah, it was probably maybe 14 at the time, somewhere in that range, and I started buying some VIX options.
Yeah.
And call spreads. I've done both. Just single call options, which is a little better payoff if you have a big event. Call spreads, which are better risk to reward if there's less of an event. And it's a bet that we were going to have a bout of volatility. And a good analogy for that is we're kind of meteorologists, right? It's not that we can predict what's going to happen in the future, but you can start to see
metrics,
some signs, some data, some information. And sometimes, the hurricane veers off course and it doesn't hit. And you bought some protection and it didn't come in, and you're probably
turns back into a tropical storm, and it just rained on Tuesday. That's kind of what it turns into.
It can be that, or it can be worse than what the market was anticipating. And so you have to, it's the trajectory, it's the expectation for, well, what's it pricing, and then how bad is this going to get?
The thing I liked about the bet, though, and we talked about it, Corey, in our text, we talked about it, and we talked about it a couple of weeks ago, is when you look at the proportionality of the move, this was disproportional even. This is an extreme example, but for example, let's say that if you went back to COVID, probably a 30% drop in the market, probably the fastest 30% we've ever seen it drop. A lot of things went on sale. And you're looking at a VIX of what, maybe...
It went up to 80 something
like that.
Yeah.
So when you get a VIX that high, well, think about this. Yeah, you're going from, let's look at where the market would be now. If it's let's just call it 5,000 for a nice, I know it's above that, but if you went from 5,000 to 4, that's a 20% drop. 20% drop from 5,000 to 4. But that would be a VIX going from 12 to like 670, 60. So you have this huge movement in the VIX, which provides opportunity for profit. Huge movement in the VIX, with a significant movement in the S&P. But it's really interesting. I ran a chart for our ARMOR class of that exact volatility we had last week.
Yeah.
And we had a 400% increase in the VIX on a 3% decrease, or 3 to 5% decrease in the S&P 500.
Yeah.
So when you can buy something that's already leveraged with options, and you have a leverage of 100 to 1 on those, and then you leverage that with a 400% movement relative to that, did you get lucky or smart on that? I don't know which one it is. I
We'll
think
call it luck, but what the VIX is really good at is tail risk. And so in statistics, when you look at statistics and where one standard deviation, there's a 68% chance it's going to be in this range. We can measure that down. We teach our students, you can measure it to exact numbers. Here's the probability. Here's the outside of those ranges. What the long calls on the VIX or that type of strategy is really good at is that tail risk. And when traders or investors talk about tail risk, it's that event that's outside of the...
Keeps on going on you.
Yeah, it's that event that's bigger...
Bad to worse.
Yeah, that's bigger than expected. And that's really kind of the VIX's move last week was it was a great tail risk hedge where you had that extreme move because the markets didn't move that much. The S&P really didn't fall that much in terms of percentages, but the VIX exploded.
And if the contagion continues, that leverage is nice.
Yeah.
But what I liked about it is if you look at, out of the money calls on the VIX, those are going to be cheap when the VIX is at 12, 13, 14.
Oh, yeah.
It's really cheap money, especially if they're out of the money. So it's not really a lottery ticket, but that's what insurance is supposed to be, is when you take a small amount of money, you got a $1 million home or whatever your home's worth, and you can take a small amount of money and insure a lot.
Yeah.
And that really appealed to me, was the cheapness of it. Again, you don't go all in, and then if you decide that you're not going to go unlimited and you're going to do a spread trade, what we call a debit spread, you say, well, I'm going to bet on making money in this wide range, but I don't want the infinity because I don't think it's going to infinity. So maybe I say from 20 to 25 or from 30 to 35, whatever you want. That even reduces your cost more because you're sending some premium out, but you're bringing some premium in.
Yeah.
So you probably had some triple digit returns on that.
Yeah. And those debit spreads.
And I'm not saying 100. I'm saying like 300 and 400%.
400% type of returns. And depending on how those spreads settle out, it could be more than that if you held to expiration, because some of those spreads that you build, I mean, I was looking at...
The time decay is in your favor once it gets up there.
Yeah, as an example, I was looking at one at the end of last week, a low probability of it paying out, but it was 30 cents cost for $5 a max gain. So you had basically $30 at risk for $470 a max profit.
Per contract.
Per spread, so do the math on that. And if that thing pays off, you're talking about thousands of percent instead of hundreds. So again, it's not a high probability of it playing out. That's why you get that excellent reward to risk ratio. But if there is that tail risk move, if there is this extreme volatility, those things can pay out. So this is where, when you look at the history of the SIBO, the Chicago Board of Options Exchange, they had two big trading pits. They had the SPX pit and they had the VIX pit. And the reason is big institutions use those two instruments for hedging. If you want to hedge your portfolio, you use the SPX for the normal. Those are kind of the bigger hedges. And you want to protect yourself for the next 5 or 10% down in the market, you use the SPX. But when you want to get that tail risk hedge and that bigger payoff for less risk, not spend a lot of money, but have the bigger payoff. It's a better proportional bet, because if my portfolio takes a massive hit, go back to COVID, if you had some VIX stuff on during COVID, you had enormous profits in the VIX to offset a lot of downside in the portfolio, and potentially, depending on how you position sized, you could have made more in your hedge than what you lost in your portfolio. And so things like that.
That's Eddie Murphy.
It is. Yeah.
If you've ever seen Trading Places, that's my favorite scene in Trading Places.
That's one of the better movies about the financial markets.
It really, it's about the turtle traders. It comes from a true life story. And there's a scene, if you haven't seen it, you got to go watch it. You can't let your kids watch it because it's a grown-up movie, but but it's on TNT every year at Christmas with all the Jamie Lee Curtis scenes cut out of it, so you can have a family-oriented thing. But it's really that they have Eddie Murphy in there. What's his name? Jimmy Valentine?
Mr. Valentine.
Billy Ray? Billy Ray Valentine.
Something like that.
Yeah, they put him in a suit and they give him this penthouse and a butler, and he doesn't believe he's in this experiment. And so he goes, "This is my vase, right? I can play Metal Lock Lemon." He plays with the vase and it crashes. And he goes, "That's a fake, right?" And the Mortimer brothers say, or the Dukes,
Randolph
the Dukes,
and Mortimer.
Randolph and Mortimer, the Duke brothers say, actually, that's your vase. You just broke it, and it was at $30,000. But I think we estimated it with the insurance adjusters at $45,000. Yeah. You just made us $15,000. And then the first says, "Want me to break something else?" No. But that's really what can happen in the markets. Is Cuban did the same thing. At least he alluded to it. He said, "I was insured on my Yahoo and then some." So actually when the Yahoo pulled back, I think he had a lot of it. So he sold $1 billion of it before it even went up further. Yeah. So it wasn't like, he was being more prudent and predictive, I think. But it's kind of like if your house burnt down, "Oh, how did you know? You're a genius." No, you just have insurance, right? Yeah. Now you had talked in the Mentor Club, speaking about defense, you had put some collars on. Mm-hmm. And so Corey's got a couple of trades, a handful of spreads and a handful of, maybe more than a handful, you sneaky devil, but you had put some collars on.
This was one of those situations where it is better to be lucky than good. We had the collars on, not because I knew this event was coming, but because earnings was the week before. Yeah. So I collared it just in anticipation of downside risk control. And the idea of a collar is you give up opportunity risk.
But let me interrupt you there. Let me interrupt you there because I think you're about to make a really important point. I don't want anyone to miss it. You started talking about volatility of the VIX and that volatility, costs more insurance. Well, when you have an event such as earnings, that's an unknown. Are they going to meet earnings? Are they going to miss earnings? And that unknown increases the risk in holding that stock if you're a trader.
Correct. Yes.
Therefore, going into that event, you're going to have a higher volatility, more unknown, which is where you might look at that collar.
Correct.
And that's why you were doing it.
Yeah,
right?
I mean, you could, if you suspect there's going to be a negative earnings reaction, you can either buy your insurance way ahead of time before the risk is being factored in.
Before the insurance is expensive.
Which is like 6 weeks ahead of the event. Or right ahead of earnings, the premiums are elevated because of the unknown risk. And so what happens is you can sell a call option and get some big premium because they're expensive. For those who are speculating, they're expensive. And then you can turn around and take the premium and purchase your protective put options.
It's exactly what Cuban did on his Yahoo. The first round it was out of pocket because he couldn't sell calls because he was bound to he had a vesting period. Mm-hmm. Yeah. Where he could not sell. I mean, here you get $5.7 billion in Yahoo stock. Like, you're not going to insure that. He said he took every dime he had, millions and millions of dollars, to insure the billions in stock. He says he spent every dime he had on it. Once he was able to sell it, he could sell those calls, elevated, and take that money to buy the insurance. So the insurance essentially is self-financed.
Right. So we took some of the bigger positions we had in the portfolio and collared them ahead of their earnings announcements. And just so happened that each one of those stocks on earnings, they beat their earnings, but the guidance must have been a little lower. And so the stock prices gapped down even ahead of this event. And I was just waiting for the dust to settle before I unwrapped the collar. And usually what that means is you lock in a profit on the options, and you're still holding your stock at the end of the day, of course. That's the goal. And then when this little event of the Japanese carry trade unwinding, which is kind of the catalyst for the sudden sell-off in the market, we already had a good deal of the portfolio insured, and all we had to do was go add some supplementary insurance to the portfolio to take care of the positions that weren't collared, that weren't insured.
You talk about that Japanese carry trade. Those things seem so obvious in hindsight, don't they? And it's hard to see in foresight. It reminds me a little bit of the Polish zloty. I hope I'm saying that, pronouncing that correctly, the Polish zloty. And the Swiss franc, remember that? Where they decided to mess around with how the Swiss franc was pegged.
Yeah, so they.
You remember
I
that?
thought they pegged it to the euro.
They did. They
Right.
pegged it to the euro, and what happened is many of the people in Poland had borrowed money in francs to get their mortgage. So they were paying off a mortgage in Swiss francs. Thousands of people, but maybe millions, I don't know, but a significant amount. And so all of a sudden, when they changed this, the exchange rate between the zloty and the Swiss franc, it changed. And so now all of a sudden you had to work for 20% more zlotys to buy a Swiss franc.
Yeah.
Their mortgage, in essence, exploded by 20%. Their house payment exploded by 20% simply because of an interest rate change. Well, that's kind of what happened in this unwinding in a way, in that, you have a carry trade. I mean, that's basically a carry trade. If you wanted to understand a carry trade, those mortgages were, I guess you could say that was a form of carry.
Yeah.
Where you were trying to borrow in one currency when you're earning another and take advantage of that difference.
Well, imagine you owned $1 million on a house, and then you woke up the next morning and you owned 1.2.
Yeah.
Just because the currency moved, you know. And so we don't have that issue here in the U.S. because our debt is in dollars and we get paid in dollars and we spend in dollars, so our currency. But where other countries, a lot of times, a lot of emerging markets will take out debt in U.S. dollars or in other currencies, but then they're making their money in their own home currency, and so it creates volatility and risk there.
Yeah,
and that's a form of a carry trade, which is basically you have risk to this currency moving, and it getting more and more expensive if you're short it. Or if you're long that currency in some way. Well, with the Japanese yen, people are short. So as that currency goes up, that creates enormous pressure. And then on the other side of that, they own something against it that's probably going down, because usually the Japanese yen is a defensive currency. It tends to go up when things are, so they're getting hit on both sides. Basically, they're losing on their short and their assets going down in value. And then that unwind of that margin calls and things that come in are part of what fueled that whole volatility event.
Here's what's rough with debt. Debt is an asset. Debt is always an asset on one balance sheet and a liability on the other. Your mortgage is your liability, but it's the bank's asset. Your house payment is your expense, but it's the bank's income. And so, especially with the idea of amortization, you're paying interest. I mean, that's profit for those guys. You're not paying off principal with that. They're going to try and refi every 7 years. So the idea of understanding that a liability is an asset on a different balance sheet is important, because what happens when you're a bank or a financial institution and a great portion of your assets are liabilities to other people? Well, when people start to get squoze, then you wind up with what we call troubled assets.
But if you bundle all those troubled assets together,
they're no longer toxic.
They tried that in 2008.
Yeah. That was one of the greatest rebrandings of all time.
When they came out with the toxic asset protection
asset
program, and then they become troubled. We're not toxic. We're troubled. But all of a sudden, that makes your asset column high risk, about ready to melt down. It can kill you. So it isn't the debt side of their balance sheet that was killing them, is their asset side. And then that can sometimes represent collateral for all the other stuff you owe, and the interconnectivity. So what makes me interested in that Japanese carry trade is that didn't cause, there were some big players, in my opinion, that got squoze. And when you get in a squeeze like that, you get the worst thing in the world is when you have margin calls where you have to sell something good before it's time. Like, guys, in trading, for our listeners, let's say you're in a bunch of iron condors or a bunch of spread trades, and you really are in that range of, if you held at expiration, you'd be fine, but you're underwater in the time being because your time is not decayed enough. So all of a sudden something bad happens and you got to liquidate all this stuff that would have worked out great if you hadn't had to liquidate, and then you just compound your losses. Yeah. And that type of domino effect can happen anytime. And what I thought was interesting about this particular dip is two things. it did bounce back, so it means there's a little bit of resiliency, but there's a point underneath the surface where those dominoes, they kind of stopped falling, and there wasn't enough pressure to keep the dominoes pushing. But with a big enough event, there's enough leverage out there in the market that when people start have to cover things, it can really become difficult.
Yeah, and I think the reason this one didn't have more of the dominoes is because it was just that. It was a liquidation of people that were over leveraged, but it wasn't a systemic issue.
Yeah,
it wasn't,
they weren't interconnected.
It wasn't COVID where everybody, the entertainment world shuts down. It wasn't the global financial crisis. So it was relatively contained.
Compartmentalized.
Yeah, but that doesn't mean that the next time, and to your point, there will be bigger dominoes, and I think the economy has to be a contributing factor to that. Right now, we've got a stable economy that's growing. It's not an environment right here, right now, where the market's, on that cusp of collapse necessarily, because we haven't seen the true economic turn. We don't have businesses that are highly, let's say, in deep issues, because for the most part, most companies borrowed at cheap rates and they're not having to redo their debt quite yet and so on. So there's not quite that stress right here, right now. However, I don't think we're too far off of an economic situation that could be a little more problematic, where we could see unemployment start to rise, where we could see that the Fed is now battling an issue where the economy's slowing and they're cutting rates because the economy's slowing. And that's a bigger issue, I think, down the road, is once the economy starts to turn, then you start to see some of this unleveraged, or this, people being over leveraged coming unwound. And then I think we get those bigger dominoes. So it's kind of, this is the first step in that process, seeing that there's issues perhaps, but I think there's more coming behind it that can be a bigger issue, and it'll be economic.
Noah, you mentioned that you'd been watching consumer discretionary, and I think that can be a canary in a coal mine. Could you talk a little bit about why consumer discretionary, when that stuff pulls back? Well, I just know this. I'm a big believer of what's happening in my own circle too. For example, let's say I go a year and no one calls to ask to borrow money. No friends or family call to ask for money. Then all of a sudden in one quarter, I get 4 phone calls of someone that wants to borrow money. Okay. And let's say I go a year and no one's asking if the Cash Flow Academy is hiring. And then all of a sudden I get 6 people email say, hey, I just wonder if you're hiring. Or I have a nephew who's getting laid off, or I might have this. Do you know of anything? They're trying to network for jobs, right? I'm a big believer in that stuff. Well, one of the other things I'm getting is, my wife and I have a gun problem in that I only have 2 hands and I have more than 2 firearms. So I've really been better at that. Yeah. I'm running out of room in my John Wick room. I got no place to put where am I going to put another case of ammo, right? And my wife, she has these purses. And I always tell my wife, I go, why wouldn't you want like a $2,000 in your purse, buy $100 purse, instead of having $100 in a $2,000 purse. We talk about that a lot. But anyway, these designers that email us, they're bleeding because their efforts of putting stuff on sale, like designer stuff, like the Philip Plein, and I mean the Prada, all those high-end ridiculous, brands that are just a brand. So you say, look, I have this, purse. Those guys are in trouble because if you look at the amount of ads they're sending out, man, they're in trouble. They're hurting. So talk about consumer discretionary and why that can be a canary.
Well, one of the first defensive moves, it's a proactive shift from discretionary spending type companies to staples, stuff that are recession resistant, we'll say. So in recent weeks, even months now, we've seen a shift out of some of the high-flying discretionary spending and even a lot of the tech stocks, which I think the carry trade had a lot to do with the AI bump, money coming, they're borrowing in yen and using leverage and buying assets that they think are going to go up in value. And so part of that was being liquidated. But you saw money institutions
Yeah.
pulling money out of discretionary spending and speculative stuff and putting it into staples and healthcare and utilities.
Food.
And so the market's going down, but the staples and the core
Yep.
stuff just kind of
Doing a little
going up a
better.
little bit.
Defensive sectors.
A little bit defense. That's called sector rotation, and it's just one of the first moves of defense that institutions do. And whenever I see that, and I just kind of pay attention to the sectors, money's going in here. It's called money flow. Money coming out of here, going into here. You go, oh, they're rotating, and so that just means that they may not be predicting a market correction. They're just saying, hey, we're going to go where it's a little safer for now because we see some storm clouds that might.
Yeah.
Buffett would be offended if you called him a market timer. And he's loved Apple, and that's probably been his best investment. He's probably made more net dollars on that trade than any other, even more than Coke probably.
Yeah.
And half his wealth was tied up, so maybe he thought it's just a lot to
in
have
dollar
there
terms, for sure. He's made more in Apple than anything else.
he's ever done, which is weird. His best friend's Bill Gates, who hates Apple, and
Yeah.
it's funny how that works.
He could have owned Microsoft
Business
and
is
done pretty
business.
well too. But
Yeah, business is business to Buffett.
yeah.
The capital gain tax on selling, you said something, Corey, that kind of struck me as often Buffett will sell a little, but most of the time he's either in or out. Most of the time he's either in or out. If he sells half his Apple, there's a real good chance he'll sell the whole thing.
Yeah.
That's half his money in stocks. And does he see value somewhere to put that? That is a huge move because you're going to pay capital gain on that.
Yeah.
You're losing the dividend.
That
And
is
his
a big cash hoard.
investor basis, investor yield is different than dividend yield. His dividend is not the dividend yield that's at today's prices. His dividend yield's a lot, or his investor yield on those dividends is a lot. So for him to make that big of a move on a company that he likes that much, what do you read into that?
Yeah, speaking of consumers, usually market participants focus more on high-end consumers because they're more likely to own stocks. So it's a little bit better correlation for the stock market than the low-end consumer. And so when you're looking at brands, if McDonald's is struggling, that's not always a great read on the economy. But when the higher end really starts to have issues and there's big trade downs and those things happening, it usually hits the market a little harder. And Buffett making moves, kind of the same thing. It's a little bit of a canary in the coal mine of Warren Buffett is a fundamental investor. He's saying, what am I getting for what am I paying? And right now he's saying my money is better served to be out of Apple than in it. And that's a big statement.
Yeah, because inflation kills you when you're that big. You got that much cash and inflation's at, let's say it's 3 or 4%. You're losing 3 or 4% of the value of that, an enormous amount of cash.
Yeah, Warren Buffett is not an unintelligent investor. He understands that cash is horrible.
Yeah.
And yet he's saying,
That's
I would rather
place.
liquidate this position, take those hundreds of billions of dollars, which it is, and keep it in cash for now than to leave it in this stock.
Yeah.
And that, whether, we don't need to talk to Warren Buffett to see that
What
he's
he's
making
doing.
a huge statement
What
there
he does
without
is bigger than
saying
what he
anything.
says.
Yeah.
What
and
he does is bigger than what he says.
Yeah, and if you talk to him about Apple, I'm sure he'll do the usual, it's a tremendous company and they've been wonderful and so forth. And I still believe in the stock market long term. It's very much the messaging of us.
But he has said it in his letter, in his speech and letter to shareholders. He said, I don't know what's happening this year, next year, whatever, but we're going to have a thing. I'll tell you what I think, what I'm looking for canary in the coal mine is labor. And the reason, we had jobless claims were supposed to be 241,000, came in at 233. And I think the lift in the market that day was really just buying the dip from I thought it was
it's a relief rally.
Yeah, I thought it was a technical move. But CNBC, when the market moves, they're trying to find a reason. And so, look, jobless.
Hey, post hoc
claims.
rationalization.
Yeah, we
about
talked
90% of the headlines.
Yeah, but we thought it'd be 241 and we were wrong, 233. But here's the thing: the fact they thought it was 241 in the first place speaks to it, and the fact the trend is pointing upwards on the labor market. And the reason labor market, I've said since COVID, that's the one I'm watching, because the Fed has to get their hands in that.
Yeah.
See, you can have consumer discretionary, and Buffett can sell you on all he wants. The Fed will sit there with their arms folded. But when all of a sudden you have a mandate that says, I need price stability in one hand and I got labor in the other, and those are almost always opposing, it puts them in the horrible situation. And recessions tend to cause unemployment, because when you run a company and things are flush and you're growing, you got to hire labor. You got to expand. And then you're supposed to fire quick and hire slow, but you can't, because growth means hiring people. You just need it to handle the growth. And when that thing shrinks, you have to reduce that labor.
Yeah.
And so that's what I've got my eye on more than anything else. And right now, labor's, it's going to get tougher, because inflation is going to cause people to spend less.
Well,
and that starts that
a
downward.
couple of other things I'm seeing are credit card balances are
Oh
near
my
all-time
gosh,
highs.
did you see those numbers?
Default
Have you
and
seen those
default
numbers?
rates have taken an uptick.
Because those are variable rates.
Yeah, delinquency rates are like 1 out of 10 credit cards.
Oh my
right now
gosh,
is
no!
delinquent.
I was looking at a chart of post-COVID credit card use, and talk about people that have lost
Exploded.
their freaking minds. Credit card debt is insane right now.
Yeah. And those are all, I mean, it's all part of that domino effect, right? And that's where I think the economy tipping over is the issue. If we do go into a recession and so on, there's going to be, the unemployment rate is going to make that upward curve. And as people are losing jobs, they're going to spend less, and the high-end consumer is going to trade down. And the stock market follows the economy, and a lot of times it leads the economy, because the stock market doesn't wait until the economy is in shambles to go down. The stock market is what they call a discounting mechanism. It's darn smart, and it says, well, what are the numbers trending towards? And if they're trending towards this in 6 months, and our unemployment rate is going to be going up and the GDP is going to be going down, they read the tea leaves and they go, well, we got a problem here, because if people are losing their jobs and then this happens and then this happens, there's no way that stocks with the S&P at 5,300 are going to be that high. We're going to start selling before that economic data hits in the coming months. And so it's a forward-looking mechanism, and that's where, as investors, we've got to start to look at those trends, and we've got to start to say, labor is a big one. We've got to start to say, okay, if people are losing jobs and that's going to be the trend, then we got to get out ahead of that, not behind it.
I think a big part of the economy, and tell me if I'm wrong on this, push back on me if I'm wrong on this, but I also look at housing starts, because when you buy a house, and you buy one bigger than you had before, you fill it with stuff. And that triggers, a house triggers so many purchases of furniture and paint and carpet and fixtures. And I mean, so many material things go along with that. Well, at these interest rates, I don't know how many people say, well, I think I'll sell my house at my 3% mortgage to take on a 7% mortgage to buy another. I don't see that. And I think that's another one I'm watching is when that cools, so many, like you saw that in construction, where those guys got killed in 08. They got killed. But there's so much irrational exuberance and so much leverage that I think when the economy turns, we have not learned our leverage lesson. And maybe they're dependent on the Fed put. Maybe that's what it is.
I think that's kind of the Fed put is one of the reasons that people behave so, I don't know if the right word is cavalier or they're not as worried. They're just not as worried about the downside, because they've had their back, they've bailed them out, and at some point in time.
Kind of rough though. I guess, and I might not be an expert on this, but I look at the difference between COVID and a subprime bailout, and it really was how much money remained institutionalized between the institutions of the Fed and how much got into Main Street, because they could be aggressive. I think what we learned was they were extremely aggressive. that money does leak out in the economy eventually. But if I'm an institution like Goldman, and I say, all right, I'm going to sell a bunch of bonds, right? And the Fed will buy my bonds from me, right? Or whatever. I get flushed with cash. What do I do with that cash? I turn it around, I give it right back to the Fed and say, now pay me for those deposits, interest. So where does that money ever hit Main Street where it's in someone's pocket to go buy a TV? It doesn't. Am I wrong in that? But with COVID, they're sending out checks to people like, hey, I'm buying a new TV.
Yeah, it hit individuals. And, can the Fed continue to backstop this? Can they be that protective foot where we've seen inflation go above 10%? They ought to be afraid of stepping in the next time.
It's transitory.
Yeah.
It's transitory.
You got to do that in like
asset.
a Trump voice or something.
It's transitory.
It's transitory.
It's not transitory.
Yeah.
You're pretty good at that, actually.
I've practiced in the mirror. I'm not lying.
Yeah. Just for this moment.
Unbelievable.
Nailed it. But, I mean, they ought to be afraid of that stepping in because price stability is huge. You lose the U.S. dollar, you lose everything.
You go that's Banana Republic stuff.
Yeah, you can deal with economic downturns. You can deal with years of, some stagnation and so on, but you can't risk losing the U.S. dollar. And
I don't think it was hyperbole.
viability.
Munger said, look, who knows when inflation runs out of control, is what he said. He says, when it does, you wind up with something like Venezuela. I mean, that's Munger saying that.
Yeah,
that's
scary stuff.
That is scary stuff. So anyway, great podcast. I didn't do a commercial, so I apologize.
Go to yourinvestingclass.com.
Go to yourinvestingclass.com. And I really am going to begin to challenge people more aggressively. I mean, it's no skin off our nose. I mean, Corey's got his VIX puts, so he's fine. Or his VIX calls.
Yeah.
He's got his VIX calls and his spreads. I think learning how to use a future to delta hedge right now, it's not so much that I even care about the delta hedge because I'm willing to ride stuff down because I don't lose one share. And if I believe in the company, who cares? What I'm more excited about is the idea of filling my pocket with cash in an effort to be able to have even more cash to buy low when things go on sale. I mean, that is, that's the armor part is the OR. It's not just the advanced risk management. It's the opportunity readiness.
I'm already starting to compile my list of stocks that I'm going to be most interested in.
Yeah. I mean, can you imagine how beautiful it would be?
Yep.
How beautiful. What great timing. AI's propping up tech. It's propping it up, right? But man, if we could have a nice crash of decent proportions and you could go in and scoop up some AI stuff on the cheap right now. Yeah. Oh my gosh. I mean, 10 years from now, you're going to be like, oh, geez.
Yeah, always.
It's so exciting.
You just don't want to let that opportunity go to waste.
No.
And that's where 2020, 2008, these big
bargains.
Market meltdowns, if you can take advantage of that, and you have to be prepared. I mean, it's nice to say, oh, when that happens, I'll be ready. No, you got to prepare now. You got to start thinking about, well, how do I go about protecting what I have so that I can compile some cash so that when that opportunity is there, I'm ready. Because when you're in the midst of that, it's easy to say, but when you're in the middle of it,
it's nutty.
It feels different. You start thinking, well, maybe the economy won't ever recover or whatever. I don't know what.
Maybe this is the end.
Yeah, I mean, it's weird, but your mind fear is a very real thing. And people start worrying about, well, what about my job? Maybe I won't keep my job. And so there's all these fears, and there's a reason why people don't take advantage of those. Yeah. So you have to be ready, and it takes education and readiness.
You hit one of the great emotional turmoils is if a person has a job and they're afraid they're going to lose that job, cash becomes king.
Yeah.
And the ability to take cash and put it into a investment rather than having it in case, that is a big turmoil, I think, for people.
And so being ready with both, being ready with some emergency preparedness capital and some investment capital, and
but also being prepared tactically. Like my brother's a police officer, and I ask him, when he draws a gun, it's pretty serious. Whenever he's had to draw his gun, he's been shot at and all this stuff. He goes, the training kicks in. Like
Yeah.
it's not your first rodeo. So
Yeah.
one of the things we encourage is to get your paper count, get in the mentor club. Like you don't want to be delta hedging with a future for your first time live.
In the middle of
Right.
a chaotic
You don't want to
event.
be
Yeah.
like, oh, I'm going to buy calls on the VIX and for the first time
Yeah.
live. You want to practice this and been comfortable with it and been through it. And even had a few, I've had more than one where I've gone delta neutral with, well, not quite neutral, but maybe 20% hedge with some futures. And maybe I lose some in those futures. If I've been wrong, they go up, hits your stop, and you're out. Well, your portfolio made up for that. It's a delta neutral. I missed, a little period of time, but to have the experience of knowing what it's like to put an asset on that thing and just
it's huge.
neutralize everything, and having been through that and knowing how you don't want it to be your first rodeo when it's really messy.
Yep.
And each one has been better for me. The best one I ever had was COVID, because so much learning from the dot-com bust, so much learning from the subprime meltdown. The COVID for me was my favorite crash. It's like, I was like, this is gorgeous. Like, people are going to stop using their cell phones. People are going to stop using Verizon. People no, if these prices are down, people are still going to buy Coca-Cola at the grocery store and buy these low.
Yep.
So I'm pretty excited. Great discussion just generally on the market. Let's close with this. This is a little wonky. I hope it's not a non-crescendo. You did a great video on our text where you were analyzing the VIX. And even though it's a little wonky, my mentor, Robert Kiyosaki, I can always hear him, don't go small picture, stay big picture.
Yeah.
So I feel those reprimands in my head. But I would like to talk about, you gave a great analysis as you dug into the numbers on the VIX. And we've had flash crashes, but you can also have a bad tick.
Yeah.
And so explain what a bad tick is in your findings on that.
Yeah.
The VIX at 60 with only a 5% drop didn't add up.
Yeah. And so the VIX at 60 would suggest, it would suggest that was the third biggest volatility event in the last 30 years or what have you.
What you're saying is the fear gauge spiked a little higher than it was in reality. So there was a read on that made people think, uh-oh.
There was a reading on that suggested that we were
Inaccurate.
similar to COVID or similar to 2008's global financial crisis, and that's just not reality. And then as I dug into the numbers, I looked at the futures, and the futures are trading the VIX, and they trade overnight, 24 hours. And I looked at the August futures, and it had only spiked in the 30s. And I looked at the September, and it had only spiked in the 30s. And the October, and so the VIX in reality was only a 35, 37 some odd spike. That's the reality.
Yeah.
So even though when you pull up a chart of the VIX, you see a 65 reading, it's not reality. The reality is we had a spike to the 35 range. Well, put that in context. In the last 10 years, we've had numerous spikes to 35. So did we have a volatility event? Yes. Did we have a volatility event that was similar to those crashes? Absolutely not. That just was not that. Now, the next time, if the VIX truly is up at the 60 level, the futures will be up at those levels, my guess, and the stock market would be down probably 10 or 15%. Imagine we had a true VIX spike to 60. The stock market would have been down over 10% on the day. It had probably been down 15% or so. So put that into context. Now you're talking about a market that goes from 5,200 to 4,000 or some number that's pretty dramatic in a single day. Now that's comparable to 1987 and Black Monday when the stock market fell 20% on the day. So there are some things that the markets have put in place, trading curbs and trading halts where they try
breaker switches
where they basically shut the market down and say, let's let everyone calm down a little bit and then we'll reopen.
Yeah.
Usually when they're shutting the market down like that, there's more to come. It's not a sign of health or, strength in the markets, but just understand that VIX spike we saw to 60 is not really what happened. The true reading was more of VIX in the mid-30s.
What's funny is when you have that little crash, or we'll call it a pullback, not a crash, is I went back to see where we were the last time we hit those levels for the first time. This is a great mental exercise to do, by the way, when you have a big day in the market where everyone's losing their mind. So let's say we lose 1,000 points on the Dow or something like that. You know, Dow's down 1,000 or S&P's down 300 or whatever it might be. Just go back and see where it hit that for the first time.
Yeah.
It was April.
Yeah.
So let's say that the S&P is at 5,300, let's call it. You know, whatever. The S&P is at 5,300. Okay, when did it hit that for the first time? April. So when it hit 5,300 in April, did everyone lose their mind about that level?
Yeah.
It was the high. It was like, this is incredible.
They were
it's at the same level. It's the same level it was in April, and people were just loving life, right? What I think is interesting as I look at this chart right here on my phone is the kiss goodbye.
It's in there. It's in there.
You look at the technical analyst get stimulated right now. Look at Noah's face right now.
I have my doubts about the initial rally. It usually goes drop, rally, and then maybe drops off.
I said kiss goodbye, and he just went ear to ear.
Yeah.
Yeah, I like that one. It's a classic pattern.
There you go. So, thank you, Noah. Thank you, Corey. Thanks, guys. Thanks, producers. Hope you enjoyed this episode and our conversation. This is my favorite part of the week, is talking shop with you guys. Go to yourinvestingclass.com, and we'll see you next time.